In January 2021, a group of amateur investors on an internet forum called Reddit decided to buy shares in a struggling video game retailer called GameStop. The professionals on Wall Street had bet heavily that GameStop's shares would fall. When the Reddit investors started buying, the shares started rising instead. The professionals lost money, so they needed to buy shares to cover their losses, which pushed prices higher still, which attracted more buyers, which pushed prices even higher. In the space of a few weeks, GameStop's share price rose from around $4 to a peak of nearly $500. A company that most analysts believed was heading toward bankruptcy briefly became one of the most traded stocks on the American market. Hedge funds lost billions. Ordinary people who had bought in early made fortunes on paper. And for a brief, strange moment, it looked as though a group of strangers on the internet had found a way to break the financial system. Then the platform they were using to trade stopped letting them buy, and the moment passed. But the questions it raised have never gone away. To understand what happened with GameStop, you need to understand a practice called short selling. Short selling is a way of making money when a stock falls in value. Here is how it works. You borrow shares from someone who owns them, and you sell those shares immediately at the current price. Later, when the price has fallen, you buy the same number of shares back at the lower price and return them to the person you borrowed from. The difference between what you sold for and what you bought back for is your profit. If you short a stock at $50 and it falls to $20, you make $30 per share. It is a legitimate strategy used by professional investors to hedge risk and by funds that specialize in identifying overvalued companies. But it carries a specific and unusual risk. When you buy a stock normally, the most you can lose is what you paid. The stock can only fall to zero. When you short a stock, your potential losses are theoretically unlimited, because the stock can keep rising indefinitely, and you still have to buy it back at whatever price it reaches. This vulnerability is what the Reddit investors exploited. GameStop was, by most measures, a company in serious trouble. It sold physical video games through retail stores at a time when most games were being downloaded digitally. Its revenues had been declining for years. Several prominent hedge funds had taken large short positions against it, essentially betting that it would continue to decline or go bankrupt entirely. By late 2020, GameStop was one of the most heavily shorted stocks in the American market. In fact, more shares had been borrowed and sold short than actually existed, a situation called short interest exceeding 100% of the float. This was in itself a sign of extraordinary bearishness from professional investors. On a subreddit called WallStreetBets, a forum with millions of members who shared tips, memes, and occasionally very large bets on individual stocks, a user named Keith Gill, known online as Roaring Kitty, had been making the case for months that GameStop was undervalued, not because the business was great, but because the extreme short position made it vulnerable to what traders call a short squeeze. A short squeeze happens when a heavily shorted stock starts rising. Short sellers, facing mounting losses, need to buy shares to cover their positions, which pushes the price higher, which forces more short sellers to cover, which pushes the price higher still. The dynamic feeds on itself. Gill's argument was simple. If enough retail investors bought GameStop shares simultaneously, they could trigger exactly this dynamic. The short sellers would be trapped. Their need to buy back shares to limit their losses would fuel the very price rise that was causing those losses. In January 2021, the WallStreetBets community did exactly that. Millions of amateur investors, many of them using zero-commission trading apps like Robinhood, bought GameStop shares. The price began to rise. Short sellers began to feel the pressure. As they bought to cover, prices rose further. What started as a quirky internet bet became a financial phenomenon. At its peak, GameStop's share price reached nearly $480, from around $4 just weeks before. Melvin Capital, one of the largest short sellers, lost more than 50% of its assets in a matter of weeks and required a multi-billion-dollar bailout from other hedge funds to survive. And then on January 28, 2021, Robinhood, the trading app used by many of the retail investors, restricted purchases of GameStop shares. Users could sell their shares, but they could not buy more. The price collapsed. Robinhood's official explanation was technical. A clearinghouse requirement called a deposit obligation had increased dramatically due to the volatility, and the company did not have enough capital to meet it, while continuing to allow purchases. These deposit requirements are a real feature of how financial markets are structured, and the explanation had some validity. But many retail investors did not believe it. The timing, the restriction, came precisely at the moment when the squeeze was most intense, when hedge funds were suffering most, felt like the system protecting itself. Social media exploded. Politicians from both parties called for investigations. Robinhood's chief executive was summoned to testify before Congress. The conspiracy theories were never proven. The technical explanation was never fully accepted. What remained was a deep and widely shared suspicion that when the rules of the game threatened the wrong people, the rules could be changed. The GameStop episode did not bring down Wall Street. The hedge funds that lost money either recovered or were bailed out. GameStop's share price eventually fell back toward earth, and many of the retail investors who bought near the peak lost most of what they had put in. The system absorbed the shock and moved on. But what it revealed was something that had been simmering for years. The financial system is not a neutral playing field. The same strategies that are available to professional investors, short selling, leverage, complex derivatives, are available in theory to everyone, but in practice require capital, expertise, and access that most ordinary people do not have. When retail investors found a way to use the system's own mechanics against the professionals, the response was to restrict their access to the tools they were using. Whether that was justified or not is still debated. What is not debated is what it felt like to the people on the other side of that decision. It felt like the game had rules for some players that did not apply to others. In the years since January 2021, regulators have examined short selling practices, payment for order flow, and the obligations of trading platforms during periods of volatility. Some reforms have been proposed, some have been implemented. The fundamental structure of the market has not changed. Keith Gill, Roaring Kitty, became briefly famous, then disappeared from public life for several years, then returned in 2024, triggering another smaller surge in GameStop's price simply by posting on social media again. GameStop itself pivoted, raised cash by selling new shares while its price was elevated, and survived, though not as a thriving video game retailer, more as a symbol. The GameStop story is usually told as a story about retail investors sticking it to Wall Street, a David and Goliath tale with a satisfying middle chapter and an ambiguous ending. But the more interesting question is not whether the little guys won. In the end, most of them did not. The more interesting question is what it means that for a few weeks in January 2021, millions of ordinary people, coordinating through an internet forum, were able to move markets that the most sophisticated financial institutions in the world had been moving for decades. The tools exist. The coordination is possible. The question of who the financial system is designed to serve and who gets to participate in it on equal terms is not a new question, but GameStop made it impossible to ignore.